Good afternoon, everyone, and welcome to another webinar series with the market guys, most notably AJ Monty, Chief Market Strategist. And with that, AJ, I'm going to toss it over to you.
Thank you very much, Chris, and welcome to everyone who's attending this. My goal here today is not only to educate you on trend lines and support and resistance and such, but I want to help you with information that will help remove the emotions from the decision-making process and also help you protect against catastrophic loss. The 1% rule that you see highlighted on this page is something that I put together in 1988. Now I'm going to spend a little time on this slide right here for a good reason. In 1987, it was October 1987, I believe it was the 19th. It was a Monday, also known as Black Monday. The Dow Jones Industrial Average proceeded to drop 22% in value. Now, for those who did not experience that, they are now experiencing it in present market conditions. Now, back then, we did not have computers, we didn't have the internet, we didn't have cell phones, anything like that. We had what was called a Quotron machine that basically gave us market prices, and we had hand-drawn charts. Now, let me explain to you how important these charts really are. If you've never put any weight or have considered, the real benefit of this, let me start by saying that the trend is your friend. If you are looking at the markets today and you see that the trend is down, then you should not be fighting the trend. Remember, the whole concept here is to make the trend your friend, not your enemy. And whether you're investing or trading in the market, it's important that you adjust your positions more or less to correlate with the trend. Now, thankfully, because of the advance of exchange traded funds and different things, if you see a stock that's breaking down a particular support level and you own that stock, it's not hard nowadays, even for the investor, to reverse positions and even go into more or less a inversely related fund or a contra fund. I'm not telling you to do that right now. I'm just telling you there are a lot of choices. And with those choices comes opportunities. Now, if you're in a position where you're saying to yourself, I can't really do anything, I'm just going to hold on and see what happens, maybe because you feel that you're beyond the point of no return. Let me just say, just calm your emotions down a bit and follow the charts. You're going to see how much sense this makes as we get through the role reversal in the trading channels and such. Okay, so the trend is your friend. Follow the trend. That's the number one rule. And the idea here is to buy with the buyers and sell with the sellers. Now, for many years, people have believed that buying low and selling high was the way to go. Well, think about that. If you bought yesterday because you thought it was low with the expectation of selling high, well, guess what? The circuit breakers triggered today and they shut the markets for 15 minutes in the morning, and it might happen again several times. Who knows? We don't know. But see, what helps you determine when there is an obvious buy point is to look at the price when it starts moving to a certain level and then reading the signals so you can position yourself on the side of those who are controlling the trend. That's why I say buy with the buyers, sell with the sellers. So if you're looking at a chart, let me just give you an example here. This is the pure definition of an uptrend. It's when you see higher highs followed by higher lows. And this tells us that the buyers are in control. Okay. Now, If you're looking at a chart for the first time, it may not be as obvious as what I pointed out to you on this slide, right? Because I'm obviously showing you arrows and title points and such. But when you're looking at a chart, and especially again, I'm talking to the novice person who is more or less foreign to this idea of chart analysis. This is a process that is, it's not rocket science. It's something that anyone can learn. So the uptrend is when the buyers are in control. Now, in order to draw a trend line, you're not necessarily in an uptrend per se, you're not necessarily focusing on the highs at that point, because when you draw a trend line, the line is drawn to connect the areas of those who are controlling or in control of the price. So obviously, if the trend is up, we want to more or less draw a line connecting the dots or the points where the buyer stepped into the market, right? Because if you're a buyer and you like a stock, you'll buy it. But if you didn't totally exhaust your buying power, a lot of times you'll buy it at a higher price. And I know that might even sound odd that you're not buying low and selling high, but believe it or not, the smart money people, and I don't mean to identify people as being smart, but it's a term. Smart money are those who have a lot of experience, and even the professionals know that in an uptrend you want to buy on strength. You want to sell on weakness, but you want to buy on strength. So smart money managers will buy as the stock goes up. So they're cost averaging up. They're not trying to cost average down. Now, downtrend, obviously, lower highs followed by lower lows. And I'm not going to talk about volume on this particular slide, but volume plays a big part of this. When the sellers are in control, if the volume is accelerating while the price is dropping, that's telling us that the trend is becoming more significant. It's not lightening up, it's intensifying, right? So when you draw a downtrend, remember what I said, you want to connect the points on the side of the market that people are controlling. So if the prices are going down, the sellers are in control. You want to connect the dots as to where they're selling. Now, if you look at this chart, obviously we have a question mark all the way to the right. And that's more or less, okay, I'm thinking about buying this stock for whatever reason. I'm giving you a scenario. I'm thinking about buying this stock. Is this the right time to buy it? Well, if it's at the downward trend line, there's a higher probability, not a guarantee, there's just a higher probability that the price will drop from that point, and therefore that may not be the best place to buy. Now, expanding on this idea, if all of a sudden the price starts breaking out over that trend line, well, that's a whole different story. That's a much, much different story where now the sellers are being pushed back because the buyers are getting more aggressive. I'm not going to go too far off on that tangent, but I'm just giving you an idea of why trend lines are so important, especially when you're managing risk. Now, going back to this slide, support, right? We talked about downtrend. We're going to now talk about flip back to support. This is a textbook, I would even call it a stick figure example of what's called the W bottom. It's a common pattern where we see that the price has dropped and then it rallied and then it came back down again and dropped, but this red dotted line held as, we'll call it the floor, okay, the floor. And so when you see a line such as this being tested a couple of times, more times it's tested, the more significance it carries with regard to strength and holding as a support level, right? So support is basically defined as a time where and place where the sellers fail to push the price to the lower levels. So think about this. The buyers are anchoring in, they're digging in their heels, and they're pushing back the sellers from this, whatever price level this is, right? Now, it's not hard to find these because every single chart and every stock you give me, we will be able to find support levels. Now, if I move from a stick figure to an actual chart, here is the stock that represents an area where the buyers are holding their line. You see back here, we see a bounce, boom, came back down, bounced again, went up, came back down. It's hovering around support. So if I'm looking at this on the chart and I'm thinking, well, is now a time to buy? You know, I could put a question mark right there and say, well, maybe it's a time to buy, right? Maybe. But I think it's going to be better if I wait a little bit, don't you think? Don't I want the buyers to come in and prove to me that they're willing to buy again at that support level rather than me trying to be the hero and speculating that they're going to push it up? You see, going back here, when the price moves down and then starts to go up, this is called a pivot point. So when you're thinking about buying, there's an old saying, don't try to catch a falling knife. Don't try to grab that assuming, oh, we've hit a bottom, because tomorrow we don't know, right? But if you wait for that pivot point and you see a clear level of support where buys have historically come in, that increases your probability for possibly making that profit. But most importantly is that red dotted line that we have on this chart. That is the place whereby we gauge our risk point, right? Remember the 1% rule? You cannot apply the 1% rule unless or until you have established or have drawn or identified a support level. Because what the whole idea of a 1% rule is, if you see the stock bouncing off support, you know that if it drops back down below this support, then your money is now at risk because you don't have the buyers there to defend upward price action. Now you're on your own. If you start buying a stock that's breaking down below support, you really are on your own because you have no other money coming into the market to help support your own position. All right, so hopefully you get that. Now, support comes in different patterns. You can see here off to the left. Hopefully you can see my cursor. Here is a stock that's been going lower, right? That's actually in a downward trend, but you can see that if I connect the dots on the downside, even though the trend line is drawn connecting the highs, you can still find support even in downward trends, because the lows, again, these pivot points that I talked about, that's an area where the buyers are willing to come in. Now, to clarify this a little bit better for you, traders, which are short-term in nature, a trader, a stock trader, not an investor, a stock trader might look to try to buy in on these support levels just for short-term bounce. An investor would stay away from a downward trend like this. Now, if I flip that on its head, you can see obviously this is an upward trend. Well, guess what? The trend line that I drew back on a couple of slides ago, that upward trend is also going to play a secondary role as support. So a trend line and support are more or less synonymous when you're looking at an upward trend. Okay, again, to the right, W bottom, we talked about that. Here represents more or less what I showed you in an actual chart where the stock is moving sideways. And I might also add that when the support level that you're drawing is horizontal in its direction, that's called a flat line, FLAT, flat line support. Okay, I'm going to get into flat line resistance here in a little bit, but first, here we go. The opposite of a W bottom is an M top, an M top. So the definition to help you is that when resistance is being displayed on a chart, that's when the buyers fail to move the stock higher. Another way to say that is that the sellers are pushing back on any buying activity. The sellers are refusing to let go and let the stock move higher. They're adamant about the fact that they're going to sell at that price level whatever that price may be, and they'll push it down. Now again, this is very similar. What happened? You got resistance connecting the highs. This is flatline support, right? That is, again, telling us where the sellers are stacking up, right? So if I'm thinking about buying, let's say, because the stock is more or less going in a sideways direction, I have to first wait for the stock to pivot up. But once it starts to move up, again, follow my cursor here. If you are a buyer or a short-term trader and you buy on this particular signal right here, because maybe you say it's a hammer pattern or what's known as a bullish harami, whatever you're seeing on that candle, you're thinking it's bullish, you obviously want the stock to go up. But what happens is when the stock starts reaching this resistance area, you have to start asking yourself, am I going to hang on and risk, the profit that I've made thus far, or am I going to get out of the position, or am I going to get out of half the position and put a stop loss order behind the other half? These are all things that come to mind when you're looking at the charts, because you're just reading the chart. You're interpreting the signals in an effort to weigh the evidence with regard to who is controlling the market. This is more or less duplication of what I've showed you in the last slide, but I just reversed the resistance lines. You see the support was drawn at the bottoms, the resistance at the top, and you can see the flatline support, flatline resistance rather here, flatline resistance up here by the M top. Okay, now this role reversal right here is what you're going to have to watch out for in this current market. This is something, if there was one slide in this whole presentation, this is going to be the most important slide, because what formerly, basically the role reversal is defined, it looks like this. A former support level. Now remember, imagine this R and everything to the right of this R did not exist. And all you're seeing is this pivot point, right? Which would be a bounce off of a support level, right? Remember what I said before, when using the 1% rule, if we buy anywhere in this area, this level of support becomes our risk management line that we draw from. So what I'm saying here is, if a stock is showing support and then all of a sudden, it's dropping below support like we've seen in recent time, what happens is this former support level reverses its role before turning lower. It's very common. It's not a guarantee that that will happen, but it's very, very common. Now, let me just go a little bit further on this one. When support levels drop, we generally see a run below the market as that happens, but eventually we do see bounces. Now, what I would say is, as we're watching the market, expect that eventually we will see some sort of a bounce. Eventually, there'll be a point where people say, all right, enough is enough. I'm going to start looking for bargains. That's part number one. But here's what happens and why this is so important. When people sell out of their positions because they're managing risk here, or the markets drop and they capitulate out of fear, and they say, oh, I can't take any more of this pain, I'm going to sell everything, I'm getting out, I'm moving to cash, whatever, they capitulate. What happens is their stock positions turn into cash positions, and they no longer have anything left to sell. That's when we see volume drops in here. We generally see volume drops right around this area right here as people capitulate, sell the positions, move to cash. But guess what? Eventually, the sellers have nothing left to sell because they're out, and the selling pressure starts to ease up, and then you get this little bit of a relief rally. And so what happens is, there's a reason for this. People who buy here or buy here or buy here, when it's down here, they're going, uh-oh, what did I do? Right? Have you ever been there? You bought a stock and it goes lower. Raise your hand. How many of you have done that? I've done that. I'm raising my hand right now. You go, uh-oh, what did I just do? It's going lower. And then what happens is, as the markets bounce, they then get into this mode of thinking where they're not looking to make a profit anymore. They're going to be happy to get out at break even. So if they're buying here or buying here, they're going to be getting out here because this dotted line represents their break-even point. So that's the psychology behind the role reversal. It happens the other way as well, and we're seeing this in a lot of stocks, believe it or not. And with every downturn in the market, there's going to be some stock that's rallying, and that's what I tell people to do. In times of weakness, in a weak market, go look for the strongest stocks that they're abundant. In fact, your trading platform will most likely have some kind of a report embedded in it. It'll show you the top sizzling stocks of the day, right? That's another place you can look. But anyway, getting back on point here, if a stock has hit resistance represented in this R, well, sellers come in here. And then what happens is it goes up, eventually breaks through resistance, and what was formerly resistance now turns into new support. You see, this is called a step up pattern. It's a step up pattern. Look for stocks that are in upward sloping trends. The role reversal is another, it's synonymous with stepping up, a step up pattern. Okay, a trading channel is nothing more than a stock that's in a sideways band or price range. That's all it is. You're basically drawing your support and your resistance parallel to one another. This is a dream come true for swing traders. Now, a trading channel could go sideways, and it could also be in an upward trend. As long as these lines are running parallel, right? It could be sideways trend, upward trend, downward trend. It's still a trading channel. And again, there's still a lot of stocks that are in these trading channels. So let's say you have a stock that's in a downward trading range. This bottom, what they call channel line, this is the trend line up above. The bottom line is the channel line. Swing traders will look for when stocks drop to the channel line, and then they'll look for bounces here, and they'll try to play it to the next upper resistance point, which is the trend line, right? These are some common price patterns I'm not going to get into, but support and resistance are drawn slightly differently in these different patterns. Like, for instance, a triangle pattern is when you have resistance and support more or less converging on each other. A broadening wedge is when they're more or less diverting from one another, and there's different patterns. But the same idea is that you're basically connecting highs, connecting lows, and seeing how it works out. Okay, now look at the upper part of the chart just prior to the recent drop, and you will see that this is more or less an example. Chris, if you could, from October, November, December, January, February, zoom into that area, because this is exactly what I just described in a sideways trading channel right there. You see that? Now, it's hard to see because the candles are small, but if you could, Chris, draw a horizontal flat line support connecting all those lows, and then draw a parallel line to that connecting all the highs. I don't know if you could draw two lines, but there you go. Go move that just down a little bit if you could, connecting the lows in November. There you go. There you go. There's a flat line support level, and now Chris is drawing a flat line resistance. Now it's a narrow trading range, but there you go. There is a trading channel, textbook all the way. Now look, at the end of February, what happened? This is long before the big scare came in and all fear started coming into the market. The price started dropping below the support level. See, now when we're using the 1% rule for managing risk, that would be our exit point. Now, it's unfortunate if you didn't get that, prior to the drop. And if you are looking at this right now and you're still holding on to the stock, now what you do, I mean, the stock is down 20% today. What you have to do, keep a level head, look at the indicators, go through your checklist, right? And look at the oscillators. Now, remember what I said. First thing that you want to do is identify the trend. Right now, the short-term trend from February to now is that the sellers are obviously in control. Chris, we could back out just a little bit. I want to look at the volume if we could. You can see the volume is still pretty high, right? So the first thing you're going to see, and I can pretty much guarantee you this, the first thing you're going to see before a stock reverses its trend is you will see the volume drop. That's because right now the sellers are in control. Before the stock forms a pivot point and before the buyers come into any market, the buyers are waiting for the sellers to calm down. They're waiting for the sellers to stop selling before they buy, right? It's kind of like goes with that old analogy. You don't want to step in front of a freight train. Now, I'm not saying there is an opportunity waiting to happen here, but now if you gravitate your eyes down to the bottom of the chart, notice all the green that's down there. See that? Now, that's not giving us a buy signal yet, not yet, but what's happening is those oscillators, being that they're color-coded in green, is telling us that the oscillators, those indicators down there, are in an oversold condition. When the oscillators go oversold in their reading, it turns to a shade of green. When it's overbought, like we see back in July, August, that's overbought, it's red, right? So put two and two together, and think about what that means. The charts are actually giving you some kind of an indication. Sellers are overdoing it, but does that mean buy it yet? No, not yet. It means the sellers are overdoing it. It means oversold. Okay. Now, there's another thing I want to point out here. There's a gap above the market right around 18. All right. Now, there's a slight gap right around 13 as well. Now, remember the role reversal I told you about. The support level, let's go back to, let's pull back on the chart just a little bit more, Chris, so we get more data. I want to look for a support level, the lowest, a resistance level rather. Okay, back in December, if we look at December and draw a horizontal line from December all the way back there last year, right? Here's how the role reversal plays in. Okay, down at the low, right there in December of 2000. Oh, that's actually 2018. December of 2018. I'm sorry, Chris, I had you screwed up there. Yeah, the very low all the way back to the left of the chart. Okay, drawing a horizontal line from there, that was a level of support that is now broken in a pretty big way. Support, or former support, is now going to turn into resistance, right? So for the short-term swing traders, that's more or less going to be the target price. Again, no guarantee, but someone who's going to get into the stock at around $10 is actually going to be looking for a gap fill around 18. That's how they position their targets based on a former support level now broken will be a resistance target line. All right. Hopefully that'll help you out with establishing maybe some targets.
Now you say this is a former support area. If you can confirm or clarify, maybe there's level of supports, because if that's a support, I mean, each bottom where it pivots could be considered a support. So maybe it's more of, I guess, a level of strength of a support. Would that be fair to say?
Well, once all support levels have been broken, right? They're no longer acting as support. They reverse their role. So the way you would look at that is, let's say you're looking at the low in June, that little dip in June, which is above the resistance area that I've identified. That would now become a secondary resistance level. Remember, that was former support, so it's going to reverse its role. See, now the challenge for someone now in looking at a stock like this is, where is support, right? Well, it's not on this chart. That the horizontal line that's right near the most recent price action, that's not support. That's the bottom of the chart. Again, not to be funny, but that's not support. You have to go back now. How far back do I go? Now you have to keep scaling back. Go to a weekly chart, go to a monthly chart, go back as far as you can until you actually find support on this stock. Where is that? Let's take a look. Can you scale back and look at let's go back 3 years. Can you go back 3 years on let's see. No support yet. Can we go back further than that? Can we go back, go 5 years? Keep going until we see something, if at all possible. Well, there you go. There's support level back in April of 2010. There it is. But at least that support level, as far back as that is, there's your support level. You have to go back a ways to find it. You got to go back 10 years to find it, but there it is. And look at where the stock is at this particular point. In 10 years, this is the biggest month down that this stock has had. And look at the oscillators. On a monthly reading, the CCI is screaming, it's oversold, it's oversold, it's oversold. Now, again, personally, I would have to look more into this stock on the fundamental side. You know, you want to also make sure, hey, this company in trouble? We got to look at their earnings. You got to look at forecasts. You got to look at company management. There's a lot that goes on into the scanning before you actually make the decision to buy it. But at least the charts are telling us, hey, guess what? $10 is a 10-year support level, and that will hold until it's broken. You see, so be an informed investor / trader. Educate yourself. Education is the best investment you can make in your time, and feel confident in it. And again, learn the signals. Chris, back to you.
Awesome, AJ, really appreciate that. Love the information. And with that, I want to thank you for your time and good luck with trading.